Section 5.1 to 6.2 Risk Management and Portfolio Construction, Active Investing, Strategies for Beating the Market. 5.1 Risk Assessment and Management. Risk is an inherent part of active investing, as it involves making deliberate investment decisions with the goal of outperforming the market. Active investors take on various risks, including market risk, sector-specific risk, individual stock risk, and the risk of underperforming benchmark indices. To effectively manage risk in active investing, consider the following strategies. Diversification. Diversification is a key risk management strategy that involves spreading investments across different asset classes, sectors, and geographic regions. By diversifying your portfolio, you reduce the impact of any individual investment's performance on your overall portfolio. Diversification helps to mitigate the risk of a significant loss from a single investment. Risk assessment and research. Thoroughly assess the risks associated with each investment opportunity before making a decision. Conduct in-depth research on the company, industry, and market conditions. Evaluate factors such as financial health, competitive position, regulatory environment, and potential risks specific to the investment. Stay informed about news and events that can impact your investments. Risk-reward trade-off. Consider the risk-reward trade-off of each investment. Higher potential returns often come with higher levels of risk. Assess whether the potential rewards justify the risks involved. Set realistic return expectations and be aware of the potential downside risks. Avoid taking on excessive risks that are not commensurate with the expected returns. Stop-loss orders. Implementing stop-loss orders can help limit potential losses. A stop-loss order is a predetermined price level at which you automatically sell a security to minimize further losses. By setting stop-loss levels, you establish a clear exit strategy and protect yourself from significant declines in the value of your investments. Position sizing. Proper position sizing is crucial for managing risk. Determine the appropriate allocation for each investment based on your risk tolerance, investment goals, and the specific risks associated with the investment. Avoid over-concentrating your portfolio in a single investment, as it can increase the risk of significant losses. Active portfolio monitoring. Continuously monitor your portfolio and stay updated on market conditions, industry trends, and company-specific news. Regularly review the performance of your investments and assess whether they continue to align with your investment thesis. Be prepared to make adjustments if new information or changing market conditions warrant a change in your investment strategy. Regular portfolio rebalancing. Periodically rebalance your portfolio to maintain your desired asset allocation and risk profile. Rebalancing involves selling overperforming assets and reallocating funds to underperforming assets. This strategy helps to control risk by reducing exposure to overvalued assets and increasing exposure to undervalued assets. Risk assessment and scenario analysis. Perform risk assessment and scenario analysis to evaluate the potential impact of adverse events on your portfolio. Identify potential risks, such as economic downturns, market volatility, or geopolitical events, and assess their potential effects on your investments. By considering different scenarios, you can better understand the potential downside risks and develop appropriate risk mitigation strategies. It's important to note that active investing inherently involves taking on more risk compared to passive investing strategies. Therefore, it is crucial to carefully assess your risk tolerance, investment objectives, and time horizon before engaging in active investing. Consider consulting with a financial advisor who can provide personalized guidance based on your specific circumstances. Utilizing stop-loss orders, position sizing, and diversification are important risk management techniques that can help active investors protect their portfolios and mitigate potential losses. Let's explore each of these strategies in more detail. Stop-loss orders. A stop-loss order is a predetermined instruction to sell a security if it reaches a specific price level. By setting a stop-loss order, you establish a point at which you are willing to exit a position to limit further losses. This strategy helps protect against significant declines in the value of your investments. When setting a stop-loss order, consider the level at which you are comfortable accepting a loss and factor in the volatility and price fluctuations of the security. Position sizing. Position sizing refers to determining the appropriate amount of capital to allocate to each investment in your portfolio. By carefully managing position sizes, you can control the level of risk in your portfolio. Avoid allocating an excessively large portion of your capital to a single investment, as it increases the potential impact of that investment's performance on your overall portfolio. Determine your risk tolerance. Investment objectives, and the specific risks associated with each investment to determine the appropriate position size. Diversification. Diversification involves spreading your investments across different asset classes, sectors, and geographic regions. By diversifying your portfolio, you reduce the impact of any individual investment's performance on your overall portfolio. Diversification helps mitigate the risk of a significant loss from a single investment. Consider including a mix of stocks, bonds, commodities, and other asset classes in your portfolio. Additionally, diversify within each asset class by investing in different industries and companies. However, keep in mind that diversification does not guarantee against loss or ensure a profit. And it is important to conduct thorough research on each investment. When implementing these risk management strategies, it is essential to consider your investment goals, risk tolerance, and time horizon. Here are a few key points to keep in mind. Regularly monitor your portfolio and adjust stop-loss orders, position sizes, and asset allocations as needed based on changes in market conditions, company-specific news, and other relevant factors. Consider the potential impact of transaction costs, such as commissions or fees, when implementing stop-loss orders and adjusting position sizes. Conduct thorough research and analysis to make informed investment decisions and avoid relying solely on stop-loss orders as the sole risk management tool. Be aware that stop-loss orders are not foolproof and can be subject to execution at prices significantly different from the specified stop-loss level, particularly during times of high market volatility or illiquidity. Regularly review and rebalance your portfolio to maintain your desired risk profile and ensure that your investments align with your long-term investment objectives. Remember that risk management is an ongoing process and requires continual monitoring and adjustment. Consider consulting with a financial advisor or investment professional who can provide personalized guidance based on your specific circumstances and investment goals. 5.2 Portfolio construction and asset allocation. Developing an active investment portfolio with appropriate asset allocation involves determining the optimal mix of different asset classes that align with your investment goals, risk tolerance, and time horizon. Here's a step-by-step guide to help you develop an active investment portfolio. Set investment goals. Clearly define your investment objectives, such as capital appreciation, income generation, or a combination of both. Determine your time horizon, whether it's short-term, 1 to 3 years, medium-term, 3 to 5 years, or long-term, 5 years. Your investment goals and time horizon will influence the asset allocation and risk profile of your portfolio. Assess risk tolerance. Evaluate your risk tolerance, which is your ability and willingness to endure fluctuations in the value of your investments. Consider factors such as your financial situation, investment knowledge, and comfort with market volatility. A higher risk tolerance may allow for a more aggressive asset allocation, while a lower risk tolerance may require a more conservative approach. Determine asset allocation. Allocate your portfolio across different asset classes, such as stocks, bonds, cash, and alternative investments. The specific allocation will depend on your investment goals and risk tolerance. Generally, stocks offer higher growth potential but come with higher volatility, while bonds provide income and stability. Cash and alternative investments can add diversification and potentially lower overall portfolio risk. Consider the historical performance, risk characteristics, and correlation among different asset classes. Allocate within asset classes. Once you have determined the overall asset allocation, allocate funds within each asset class. For example, within the stock portion of your portfolio, you can further diversify across different sectors, regions, and market caps. Within the bond portion, you can diversify across different maturities and credit ratings. Allocate based on your research and analysis of the specific opportunities within each asset class. Monitor and rebalance. Regularly monitor your portfolio's performance and rebalance as needed. Rebalancing involves adjusting your portfolio's asset allocation back to its original target allocation. As different assets perform differently over time, your portfolio's allocation may deviate from your target. Rebalancing ensures that you maintain the desired risk profile and alignment with your investment goals. Conduct ongoing research, continuously research and analyze investment opportunities to make informed decisions within your asset allocation framework. Stay informed about market trends, economic indicators, company news, and other factors that can impact your investments. Regularly review your investments and assess their alignment with your investment thesis and portfolio strategy. Consider professional advice. If you are unsure about developing and managing an active investment portfolio on your own, consider seeking professional advice from a financial advisor or investment professional. They can provide personalized guidance based on your specific circumstances, financial goals, and risk tolerance. Remember that constructing an active investment portfolio requires careful consideration of your individual circumstances and investment objectives. Regularly review and adjust your portfolio as needed, staying disciplined and focused on your long-term investment goals. Balancing risk and return through diversification and strategic asset allocation is a key aspect of portfolio management. Here's how you can achieve this. Diversification. Diversification involves spreading your investments across different asset classes, sectors, geographic regions, and investment styles. The goal is to reduce the concentration risk of any single investment and minimize the impact of adverse events on your overall portfolio. By diversifying, you can potentially lower the volatility of your portfolio and enhance risk-adjusted returns. Asset class diversification. Allocate your portfolio across different asset classes, such as stocks, bonds, cash, and alternative investments. Each asset class has its own risk and return characteristics, and they may perform differently under various market conditions. By including a mix of asset classes, you can potentially capture upside potential in favorable market conditions while mitigating risk during market downturns. Sector and industry diversification. Within each asset class, diversify your investments across different sectors and industries. This helps reduce exposure to specific industry risks and allows you to benefit from opportunities in different sectors. Different sectors may perform better in various stages of the economic cycle, so diversification helps capture the potential for outperformance in different market environments. Geographic diversification. Consider investing in companies or assets across different regions and countries. This diversifies your exposure to specific country risks, political events, and economic conditions. It also allows you to tap into potential growth opportunities in different regions. Strategic asset allocation. Strategic asset allocation refers to determining the long-term target allocation of your portfolio across different asset classes based on your investment objectives and risk tolerance. The allocation should be aligned with your financial goals, time horizon, and risk tolerance. Consider factors such as expected returns, historical performance, and correlations among asset classes. Risk and return trade-off. Balancing risk and return requires considering your risk tolerance and desired level of potential returns. Generally, higher-risk assets, such as stocks, have the potential for higher returns but also higher volatility. Lower-risk assets, such as bonds or cash, provide more stability but lower potential returns. Determine your risk appetite and allocate assets accordingly. Regular rebalancing. Over time, the performance of different asset classes can cause your portfolio's allocation to deviate from the original target. Periodically review and rebalance your portfolio by buying or selling assets to restore the desired allocation. Rebalancing allows you to maintain the intended risk profile and capture potential opportunities. Risk management, while diversification and strategic asset allocation help manage risk. It's important to implement additional risk management strategies. Risk assessment and monitoring. Continuously assess and monitor the risks associated with your investments. Stay updated on market conditions, economic indicators, and company-specific news. Regularly review your portfolio's performance and evaluate whether it aligns with your risk tolerance and investment objectives. Risk hedging. Consider employing risk hedging strategies, such as using options or derivatives, to protect your portfolio against adverse market movements. These strategies can help offset potential losses or mitigate downside risk during volatile market conditions. Regular portfolio review. Conduct regular portfolio reviews to identify underperforming investments or those that no longer align with your investment thesis. Make informed decisions to either adjust or remove such investments to maintain a balanced and well-diversified portfolio. remember that achieving a balance between risk and return requires ongoing monitoring, analysis, and adjustment. It's important to regularly review your portfolio, stay informed about market trends, and make informed decisions based on your investment goals and risk tolerance. Consider consulting with a financial advisor or investment professional to get personalized guidance based on your specific circumstances and objectives. Section 6. Evaluating performance and reviewing strategies. 6.1 Performance evaluation metrics. Assessing the performance of active investment strategies involves evaluating their effectiveness in generating returns relative to a benchmark or an appropriate market index. Here are some key factors to consider when evaluating the performance of active investment strategies. Benchmark comparison. Compare the returns of your active investment strategy against an appropriate benchmark or market index that represents the investment universe or asset class you are targeting. This benchmark serves as a reference point for evaluating whether your strategy has outperformed or underperformed the broader market. Common benchmarks include widely recognized indices like the S&P 500 for U.S. stocks or the Barclays Aggregate Bond Index for bonds. Risk-adjusted returns. Consider the risk-adjusted returns of your active investment strategy. It's important to assess returns relative to the level of risk taken. Risk-adjusted measures like the Sharpe ratio, which compares the excess return earned per unit of risk, can provide insights into how well the strategy has compensated for the risks involved. A higher risk-adjusted return indicates a more efficient use of risk to generate returns. Consistency and persistence. Evaluate the consistency and persistence of the strategy's performance over time. Look for a track record of consistent returns rather than relying on short-term performance fluctuations. Assess whether the strategy has consistently outperformed its benchmark over multiple market cycles. This helps determine if the strategy's success is sustainable or if it may be a result of luck or a specific market environment. Peer comparison. Compare the performance of the active investment strategy against similar strategies or competitors in the industry. This can provide a broader context and help identify whether the strategy is generating above-average returns within its peer group. Attribution analysis. Perform attribution analysis to understand the sources of the strategy's returns. Break down the performance into various components, such as asset allocation decisions, stock selection, sector allocation, and market timing. This analysis helps identify the areas where the strategy has added value and contributed to returns. Risk analysis. Evaluate the risk characteristics of the strategy. Assess measures like volatility, drawdowns, and downside protection. A strategy with lower volatility or smaller drawdowns during market downturns may indicate better risk management. Consider time horizon. Take into account the appropriate time horizon for evaluating performance. Short-term performance fluctuations may not provide a complete picture of the strategy's effectiveness. Assess performance over a reasonable time period to account for market cycles and investment strategy implementation. Costs and fees. Consider the costs and fees associated with the active investment strategy. High expenses can erode returns and reduce the overall performance. Assess whether the strategy's returns justify the fees charged. It's important to note that evaluating the performance of active investment strategies is a complex task that requires careful analysis and consideration of various factors. Historical performance alone may not guarantee future success. It's advisable to consult with a financial advisor or investment professional who can provide expert guidance and help you evaluate the performance of specific strategies based on your individual circumstances and goals. Analyzing metrics such as alpha, beta, and Sharpe ratio can provide valuable insights into the risk and return characteristics of an investment or portfolio. Let's explore each of these metrics. Alpha. Alpha measures the excess return generated by an investment or portfolio relative to a benchmark. After adjusting for the level of risk taken, it indicates the skill of the investment manager in generating returns above what would be expected given the level of risk. A positive alpha suggests outperformance, while a negative alpha indicates underperformance. However, it's important to consider the statistical significance of alpha and assess it over a meaningful time period to determine if it is statistically reliable. Beta. Beta measures the sensitivity of an investment or portfolio's returns to changes in the overall market. It quantifies the systematic risk or market risk of the investment. A beta of 1 implies that the investment's returns move in line with the market. A beta greater than 1 indicates higher volatility compared to the market, while a beta less than 1 suggests lower volatility. By assessing the beta, investors can understand how an investment or portfolio is expected to respond to market movements. Sharpe ratio. The Sharpe ratio is a risk-adjusted measure that quantifies the excess return earned per unit of risk taken. It considers both the return of the investment or portfolio and the volatility, standard deviation, of those returns. A higher Sharpe ratio indicates better risk-adjusted performance. It helps investors assess whether the returns generated by an investment or portfolio are adequately compensating for the level of risk taken. However, the Sharpe ratio should be used in conjunction with other metrics and should not be the sole determinant of investment decisions. When analyzing these metrics, it's important to consider the following points: historical data. The accuracy and reliability of these metrics depend on the quality and length of historical data used. Longer-term data can provide more robust insights into the investment's risk and return characteristics. Benchmark comparison. Comparing the metrics against an appropriate benchmark or market index helps put the results into context. It enables investors to evaluate whether the investment or portfolio is generating value above or below the market. Appropriate time frame. Assessing these metrics over a suitable time period is important to capture different market conditions and avoid short-term fluctuations that may not be indicative of long-term performance. Limitations. While these metrics provide valuable insights, they have limitations. They are based on historical data and assumptions, and future performance may differ. They also do not capture all aspects of risk, such as tail risks or specific event risks, which require additional analysis. It's crucial to interpret these metrics in conjunction with other factors, conduct thorough research, and consider your specific investment goals and risk tolerance. Additionally, seek the guidance of a financial advisor or investment professional who can provide personalized advice based on your unique circumstances and objectives. 6.2 Continuous learning and adaptation. Emphasizing the importance of continuous learning and staying informed is essential for successful investing. The investment landscape is dynamic and constantly evolving, and staying up to date with market trends, economic indicators, and industry developments is crucial. Here are some key reasons why continuous learning and staying informed are important. Making informed decisions. Continuous learning allows you to make informed investment decisions based on a deep understanding of the factors that drive market movements and asset valuations. By staying informed, you can assess investment opportunities more effectively, identify potential risks, and adjust your investment strategy accordingly. Adapting to market changes. Markets are influenced by a multitude of factors, including economic conditions, geopolitical events, technological advancements, and regulatory changes. Staying informed helps you anticipate and adapt to market changes, enabling you to make timely adjustments to your portfolio and investment strategies. Managing risk. Knowledge and information are vital for effective risk management. By staying informed about market trends, emerging risks, and industry developments, you can identify potential risks in your portfolio and take proactive measures to mitigate them. Continuous learning helps you understand different risk management techniques and implement appropriate strategies to protect your investments. Identifying opportunities. Staying informed enables you to identify investment opportunities that align with your investment goals and risk appetite. By keeping abreast of industry trends, economic indicators, and market developments, you can uncover undervalued assets, emerging sectors, or innovative companies that have growth potential. Continuous learning helps you spot opportunities before they become widely recognized, potentially giving you an edge in the market. Enhancing investment skills. Continuous learning allows you to enhance your investment skills and knowledge. It enables you to develop a deeper understanding of investment concepts, valuation methodologies, portfolio management techniques, and different asset classes. By expanding your knowledge base, you can become a more informed and skilled investor, making better investment decisions over time. Navigating behavioral biases. Continuous learning can help you identify and overcome common behavioral biases that can hinder investment performance. By understanding cognitive biases such as confirmation bias, overconfidence, and herd mentality, you can make more rational and objective investment decisions. Keeping up with regulatory changes. Staying informed about regulatory changes and compliance requirements is crucial for investors. Regulations can impact investment strategies, tax implications, and risk management practices. Continuous learning helps you stay compliant and make adjustments to your investment approach in response to regulatory changes, to stay informed and continuously learn. Read financial publications, news articles, and research reports from reputable sources, follow market experts, industry leaders, and thought leaders on social media platforms and engage in discussions, attend conferences, seminars, and webinars related to investing and finance. Consider joining investment clubs or professional organizations to network and share insights with like-minded individuals. Explore online courses, webinars, and educational resources offered by financial institutions, universities, or professional organizations. Remember, investing is a lifelong journey, and the more you learn and stay informed, the better equipped you will be to navigate the complexities of the financial markets and make informed investment decisions. Reviewing and adjusting active investing strategies based on market conditions is a crucial aspect of successful investing. Market conditions can change rapidly, and it's important to periodically assess and adapt your strategies to align with the current environment. Here are some key steps to review and adjust your active investing strategies. Regular performance evaluation. Regularly evaluate the performance of your active investing strategies against benchmarks or market indices. Assess whether your strategies are meeting your investment objectives and generating the desired returns. Identify any areas of underperformance or outperformance and analyze the reasons behind them. Monitor market trends and economic indicators. Stay updated on market trends, economic indicators, and industry developments. Monitor factors such as interest rates, inflation, GDP growth, geopolitical events, and sector-specific news. This information helps you understand the broader market environment and identify potential opportunities or risks that may impact your strategies. Assess strategy fit. Evaluate how well your current active investing strategies align with the prevailing market conditions. Consider whether the strategies are still relevant and effective given the current economic and market landscape. Assess whether there are any changes in market dynamics that may require adjustments in your approach. Identify strengths and weaknesses. Analyze the strengths and weaknesses of your active investing strategies. Identify the aspects that have been successful and contributed to your performance, as well as any weaknesses or limitations. This analysis helps you determine where adjustments may be needed to enhance your strategies. Adjust investment allocation. Based on your evaluation of market conditions and strategy performance, consider adjusting your investment allocation. This may involve reallocating assets among different asset classes, sectors, or regions to take advantage of emerging opportunities or mitigate risks. Adjustments in allocation can help optimize your portfolio for the current market conditions. Review risk management strategies. Assess the effectiveness of your risk management strategies. Determine if any adjustments are needed to align with the changing market conditions. Review stop-loss levels, position sizing, and diversification strategies to ensure they are appropriate given the current risk environment. Stay flexible and adaptive. Active investing requires flexibility and adaptability. Be open to adjusting your strategies based on new information and changing market conditions. This may involve implementing new investment ideas, incorporating alternative investment strategies, or modifying existing approaches to remain agile and responsive to market dynamics. Continuously learn and seek expert advice. Stay informed about new investment strategies. Research and industry best practices. Continuously learn and improve your investment knowledge. Consider seeking advice from financial advisors or investment professionals who can provide expert insights and guidance based on their expertise and market experience. Remember that reviewing and adjusting your active investing strategies should be an ongoing process. Regularly monitor your portfolio, reassess your investment thesis, and adapt your strategies as needed. Market conditions are dynamic, and successful investors are proactive in reviewing and adjusting their strategies to stay ahead of the curve.